It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C, or 866-268-4422. Yes, you will reach me. It never fails to amuse me how surprised some people are when I do answer the phone or get back with them. And it just goes to show you how poor customer service has become in our society. Now I'm going to warn you, you're going to have to buckle your seatbelts. I've got some information I'm going to be sharing today that some of you probably are not going to like hearing. But to ignore this is to ignore at your peril. Rather tell you what you need to hear than what you want to hear. So here's some of the concerns that we have with the markets right now. The Buffett indicator now sits at 233, which is the highest number ever recorded. This is a measure of the stock market, and it's based on market cap to GDP ratio. According to the Buffett indicator, the markets and stocks are the highest overvaluation ever recorded. Also, the Schiller index. It measures adjusted price to earnings ratios for the S&P 500. U.S. stocks now are one of the highest levels they've ever recorded in 145 years of data. The Schiller index has now risen above 40. The only other time we have seen this ratio in the past 145 years. Now think about that, folks. We're even talking about the booms of 1929 and all of that. The only time it's been higher was the 2000 dot-com bubble when the Schiller index briefly hit 44. We are now above 40. We are closely approaching that number. The Schiller index is now 2 times higher than the long-term historical average of about 17. And this is a divergence that's rarely ever been seen. The conclusion is U.S. stocks are pricing in perfection. And history suggests perfection rarely lasts for long. The Bank of America bull and bear indicator is now screaming a sell signal. The metric goes from 0 to 10 and is now at an 8, is considered a strong sell signal. And historically, this Bank of America bull and bear indicator has given 17 sell signals since 2002, and stocks over the next 2 to 3 months after these signals have lost anywhere from 2 to 20% over a 2 to 3 month period each and every time. Another warning signal. U.S. consumer stocks just fell below the 2008 financial crisis levels. This has only happened twice before, in 2008 and during the COVID shutdowns. What this indicator signal is showing us is that the consumer is collapsing. They've run out of money. I've shared this on the show many, many times. It's the cumulative effect of inflation. I hear this story every week from folks, and we'll be discussing their financial situation, their expenses, their budget. And in most cases, cost of food, for example, in the last 5 years has doubled. It's not increased the 30% that the numbers you hear from the government inflation numbers. The government changed how they measured inflation about 20 years ago or so. I shared even on this very show when inflation hit 9% a few years ago. According to the government, if inflation had been measured the same as it was in the 1970s, inflation level would have been 17%. So the cumulative effect of inflation that we've seen over the last 4 or 5 years has been generational and historic. The government used to take a basket of goods and services, things that people typically purchase, like milk, bread, various things on a regular basis, and that's how they measured inflation. They would also include things like cars or appliances. They would measure those on a much lesser level because how often do you buy a car versus a loaf of bread? Obviously, far less frequently. Well, about 20 years ago, They decided to change it up and count a refrigerator, for example, the same as a loaf of bread, which is ridiculous. You don't buy a refrigerator every week or two like you might a loaf of bread. And much of the inflation has happened in the areas where people purchase items more often. The second thing the government did was they used to have a static basket of goods, the most common, typical things people purchased. They changed it to a rotating basket where they could pick and choose. And obviously, they pick and choose items that have not gone up as much typically. So it makes the numbers look better. It's one of the ways to manipulate the numbers to make it look better politically. So again, the reality is we've dealt with historic levels of inflation. And although the rate of increase of inflation has declined, it's not going down, it's still going up. If you have a 2.5% inflation rate, for example, it's still continuing to increase by 2.5%. And that by itself is not a problem. It's the cumulative total of all the inflation over the past 5 years that in many cases, food costs, for example, have increased 50 to 100% for many families. So these measurements of the collapsing consumer are particularly concerning because it's the consumer that drives the economy. About 2/3 of GDP, gross domestic product, is driven by the consumer. And the warning signs are everywhere. Consumer sentiment is at record lows, lower than we saw even in the financial crisis of 2008-09. Many economic conditions are at record lows. Inflation expectations have now risen. We're going to discuss that further in this show. Higher for longer interest rates. That will have a negative impact on the economy and likely many stocks and real estate, for example. Household finances are at record stress levels. Credit card debt, for example, is highest levels ever seen. Auto loan debt, etc., many others. And another recent concern that many people now have is the market may have to absorb the massive IPO demand from SpaceX, OpenAI, and Anthropic. The questions being asked is, where is the money going to come from? Many of these large institutional investors that own significant amounts of stock, the technology sector, where are they going to get the money from? They're probably going to sell some of their winners to buy into these IPOs. There's an even bigger concern, and this has to do with AI, which is what has driven the stock market over the past few years. The Chinese AI wave has now not just cut prices, but it's destroyed the entire funding logic behind the American AI bubble. Chinese AI models are now coming in priced 90 to 95% cheaper than the American AI models. They're cheap, fast, and useful enough to get most real-world jobs done. They're not quite as good quality-wise as the American AI. That's a recognized fact. But as this person explains, she went from $3,000 a month on Claude to $5 a week on DeepSeek. And honestly, she stated about 80% of my workload is identical. She was burning $3 to $5 grand a month on Claude Code. Every idea from design to development to testing, full end-to-end automation, simulating users to test her products and provide feedback. It was extremely token intensive, which made it insanely expensive. And then she discovered DeepSeek version 4. And as she stated, it's game-changing. The results are $5 a week in cost versus $1,000 a week in cost. And it'll do about 80% of the daily work of what she was paying for. She also states because it's not so complicated, it's actually 3 times faster. Now, which AI system is going to win in terms of the dominant AI use player out there? Too early to tell. But it has to be deeply concerning, and I'm going to share some more details about this on what some CEOs have been sharing recently, where you have a competitive product that isn't quite as good, fair, is faster, can accomplish 80% or so of AI tasks, but costs 90, 95% cheaper. Why in the world would you pay 10 to 20 times more to accomplish the same job? Basic economics teaches you that the most likely scenario is 80% of the tasks going to be handled by the far cheaper option, the Chinese versions. And then the 20% of complicated tasks will be handled by the more advanced, more expensive AI. And if that turns out to be true, then the demand and usage of this AI will reduce like fivefold. This could be a cause that would burst the AI bubble and would have devastating impacts to the stock market. Now, if you want to protect yourself, this is the golden age of fixed assets. We have index growth annuities that have averaged 10 to 14%, 10, 15, and 20-year track record history with no downside risk. So if the markets continue to go up, great, you get tremendous returns. But if they correct, you don't participate in the downside. And then when the inevitable correction then comes back, instead of having to recover all that lost ground, how long could that take? Years sometimes. You start from the much higher number because you did not participate in the downside. Contact me at yourpersonalbank.com for more information. Stay tuned in the next segment. I'm going to share with you what some of the CEOs are quietly doing as an AI replacement plan. I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com. Or toll free, 866-268-4422. Yes, you will reach me. Why this latest version of the Chinese AI is so significant and you should be concerned about, regardless of whether you use AI or not, or even understand it. There's no doubt that this recent run-up in stock values has been largely dominated by what many are just calling the AI bubble. And if this tremendous increase in valuations doesn't pan out in terms of results, profits, then we're going to see a repeat of what has happened in many other bubbles, which will burst, much like we saw in the dot-com bubble and then burst. Many CEOs are now quietly realizing that the AI replacement plan has actually two problems. One, the costs for running AI agents are now exceeding what they were paying the employees that they fired. When your tokens run out, the AI stops. There's no continuation. There's no workaround. When something goes down, employees can help you fix it. AI just invoices you for the outage. And here's another problem that many CEOs are coming to realization. To do its job, the AI needs access, full access. Your systems, your patents, your contracts, even your future plans. Everything you spent years building, handed over to a process that has no loyalty, no discretion, no skin in the game, and really no way to protect yourself. And then when you add on top of this, the Chinese AI versions that are coming out are 90 to 95% cheaper. And not quite as good, to be fair, but pretty close. And as most users are pointing out, they can do about 80% of the job of the American AI versions, the more advanced ones, but for 1/10, 1/20th of the cost. So for a larger company, for example, it would make a lot of sense. Maybe put 80% of the projects or workforce on the cheaper AI version, much, much cheaper, and 20% on the more complicated advanced versions. If that indeed does play out, then this massive use of these large language models you hear about, where AI is going to in essence, do everything, will not come to fruition, at least for the expensive, advanced American AI models. China's undercutting them. And this is nothing new. China has been doing this type of thing for decades. It's commonly known that if you buy American made, for example, it typically is built better quality, but also costs more. And it's very common. You can get a cheap Chinese knockoff of that same item, and you have to weigh the option. Is the extra cost worth the value when you're looking to purchase something? The same thing's happening in the AI world. So why would anyone be surprised by this? I'm not. I think extraordinarily optimistic view that we have seen that AI is going to take over everything, and that the companies, or at least the American AI companies, are going to do that, is extraordinarily optimistic, and that there would be some bumps in the road and some delays, and a lot of what's been promised likely will not come to fruition, or much farther down the road than it did. Again, the analogy was the dot-com bubble. I have the advantage of, this is my 27th year in the financial industry. You gain some wisdom and experience and some hindsight in that. And the dot-com bubble was very similar. The promises, the hype, all that we saw, the way the markets moved. It feels like I've been on this ride before, if you know what I'm trying to say. And although, yes, the internet did fundamentally change the economy, but it didn't really happen until about a decade later. It took quite a while to implement, work through the bugs, and human beings to adopt a general acceptance. You always have your early adopters with any new technology, but then it takes a time for the majority of the general public to get on board. There's a delay. There's a period of time that the early adopters and the inventors just don't understand. They don't relate. The average individual doesn't jump onto the latest, newest, greatest technology and wildly embrace and learn it. It takes time. And there's those that resist that change. All of these things take time. It's a process. Sometimes it takes a generation for the younger people to come up, grow up with the newer technology and accept it and start using it. This is nothing new. Other problems companies are having. Microsoft, for example, just banned its own engineers from using AI. And the reason was the tool was literally costing more than the humans it was supposed to replace. Their whole story about AI adoption is now blowing up in their face. Microsoft gave thousands of engineers Claude code 6 months ago and encouraged them to use it. And the engineers loved it, and adoption exploded, but then the invoices arrived. And token-based pricing, which is what these are based on, means every query, every code, every debug session costs money. And you scale that out over 100,000 engineers, the numbers become so large that even a company as big as Microsoft recently issued an internal order to cancel nearly all Claude Code licenses by the end of June and force everyone into their own cheaper tool instead. Microsoft invested $5 billion into Anthropic, which created the Claude Code, told its own people to stop using the product that they invested in because it costs too much. Uber rolled out this Claude Code in December of 2025. And by March of 26, over 80% of their engineers were using it. Many of their engineers were burning from $500 to $2,000 per month each. Uber blew through their annual budget for AI usage by April of 2026. Companies that are using AI to scale are discovering that the math just doesn't work. The more employees use AI, the higher the bill is. Now, these same companies are telling investors it saves money. Yet, the companies that are using AI are finding out it costs more than the humans they were supposed to replace. And the company that makes the chips just admitted it through its own vice president. And this gap in the stock price, this is a gap that nobody in Wall Street is pricing in. It's estimated there was over $725 billion in AI infrastructure spending this past year alone. And the first companies that are actually deploying these tools at scale are already pulling back because the economics don't work. What do you think's going to happen when Wall Street figures that out, or the investors figure that out, or it starts showing up in earnings calls? See, a lot of this mirrors what we saw in 2000 dot-com crash. Because here's the other problem with what's going on with all this in the financials and therefore the stock prices. You have companies like OpenAI and Oracle and NVIDIA all investing into each other and then counting it as new sales. It's no different than what we saw in 2000 prior to the dot-com crash. Again, the only difference is then it was illegal. Today it is legal because of accounting rule changes, which frankly, folks, is not a good thing. It's estimated there's about a $2 trillion AI economy right now built on the same dollars being passed in a circle. Again, people won't like hearing this, but these are the facts. This is what's going on. It's an accounting trick, and it's 100% legal. Here's how it works. A tech giant gives an AI startup billions in investment, quote unquote. And the contract forces a startup to spend the exact same money renting servers from the tech giant. The tech giant then books that server usage as brand new revenue. The translation is they're paying themselves with their own money and calling it a sale. You can look at Microsoft, OpenAI. Microsoft invested $13 billion in OpenAI, and most of it never left Microsoft. It was cloud credits that could only be spent on Microsoft servers. OpenAI used those credits to train its models. And then Microsoft turned around and recorded that exact same spend as new cloud revenue. And that's why OpenAI's annual cloud bill is like $60 billion for a company that's only doing $25 billion in actual revenue. OpenAI is not a customer. It's a recycled funding loop. And Anthropic runs the exact same script. And every time these AI startups raise at a higher valuation, the tech giant marks up their equity and books the paper gain as profit. So they're funding themselves to create what looks like sales or profit or cash flow. Q1 2026, Google or Alphabet recorded over $60 billion in profit. $28 billion, about roughly half, was a paper markup on Anthropic. Amazon reported $30 billion in profit. 16 of it was the same Anthropic paper gain. And while Amazon was reporting record profits, its actual cash flow collapsed almost 95% because they had to spend over $44 billion in real money to build data centers. Real cash is going out and paper profits are coming in. Oracle spent over half of its $500 billion pipeline on OpenAI alone. And if much of this sounds familiar, it should. Because around 2000, Global Crossing and Quest swapped identical fiber optic capacity with each other just to book fake sales. Quest was forced to raise $1.4 billion in fake income, and Global Crossing went bankrupt. Now, the only difference between then and now is today's AI loop is fully legal under current accounting rules, where back in 2000 it wasn't. Just because it's legal doesn't mean it's safe or a good investment. And every 401k and index fund in America, every retirement account is being forced to buy more and more of these tech stocks every month because they're set that way. The loop inflates the stock price. The funds chase the prices. The chase inflates them further until one day the music stops, which is what we saw in 2000. Look, I'm not going to pretend that everyone that is listening understands everything I just shared. I threw a lot of numbers and a lot of information out there. It's all public record. This isn't a secret. This isn't a conspiracy theory. I've been in the financial business 27 years. I've seen this before. I saw what happened. It feels eerily similar. And I also saw what the repercussions were. We're in a period of euphoria when it comes to the stock market. And that's when it's the most dangerous. I'm not the only one saying this. It feels like almost like a wolf crying out in the wilderness because there's so much of a chorus of euphoria and excitement and enthusiasm. I spoke to somebody the other day where, the stock market goes up 15, 20% every year. And I said, no, it doesn't. And then she goes like, well, it has recently. I said, granted, it has recently. because it's happened so much recently, it feels like the norm. And what you need to realize is it's not. The risk has never been higher. We're seeing echoes of 2000 and the dot-com bubble. And ironically, many of the causes are echo. History doesn't repeat itself, but man, it rhymes. We're seeing an awful lot of rhyming. And the warning signs are everywhere. I'm going to share more of that in the next segment. But if you do want to protect yourself, it is the golden age of fixed assets. We are likely going to have higher interest rates for longer, which is also a negative typically is a negative for the stock market and real estate markets and etc. There are no cap, no fee products, unlimited upside, downsides guaranteed, principals guaranteed. When you lock in a gain, you get to keep it. We have products that have averaged 10 to 14% average annual returns for the past 10, 15, 20 years even. So if this euphoric market continues, great, you get to participate and take advantage of it. But if at some point the bubble bursts and it goes the wrong way, you don't lose. Lock in your gains at any time, in fact. If you want more information, contact me at yourpersonalbank.com. Stay tuned in the next segment because there's a lot of warning signs, and I'm going to start sharing what some of them are. This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C. No E on the end. F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. Now, there's several historically reliable measures of euphoria. One is margin debt as percentage of GDP or total market cap. Euphoric investors borrow heavily to buy more. And when margin debt grows faster than the market itself, that signals peak complacency. Margin debt, folks that are borrowing money to buy stocks, seeing levels higher than we even saw prior to the dot-com crash in 2000. New issues, IPOs, the quality and volume. Peak euphoria typically have a high level of that. Some of the largest IPOs expected ever, SpaceX, Anthropic, OpenAI, are happening as we speak. Retail call option, 0-day call options especially, are at all-time highs, and that is another sign of peak euphoria. Many people, typically amateurs, frankly, buy short-term, out-of-the-money calls, and that is, in the industry, in Wall Street, known as pure lottery ticket euphoria. They're just hoping it goes up. You buy a cheap ticket, it's like a lottery ticket. If it goes up, you make out big. Typically, the odds of that happening are extremely small. The short-term, out-of-the-money call options are rivaling the 1999 day trading mania that we saw prior to the dot-com bubble crashing. Another sign of peak euphoria is household equity allocation of a percentage of total financial assets. We are currently near previous euphoric highs that occurred in 1968, 2000, 2007, and 2021. And if you know anything about your financial history, you know the following years after all of those were really, really bad. Another sign of peak euphoria is CEOs and insiders selling versus everyone else buying. The insiders are selling to the public. Around 1999, insiders were selling at a 10-to-1 ratio. We're seeing similar levels now. The narratives that we hear, don't worry, this time it's different. The more confident people become, closer you are to peak euphoria. We're seeing a lot of that now, historical levels of it, much like, again, we saw in 2000. Volatility. That's another big sign of euphoria. In normal times, puts, which are insurance against the downside, are typically more expensive than calls, which are betting to the upside. In a euphoric period, calls become as expensive as puts because nobody fears the downside. This is a sign of peak euphoria. Another is the percentage of stocks above the 200-day moving average. When over 90% of NASDAQ stocks are above their 200-day moving average for multiple weeks, it's historically unsustainable. It happened in 1999, and we're seeing that happen again. Risk on assets. In peak euphoria, anything that's speculative tends to move in lockstep with little or no differentiation. Bitcoin, meme stocks, AI names, growth tech, all trade as one unit. It's called low discrimination euphoria. And the core point is this: bull markets don't die of old age. They die when the last skeptic gives up. And if you're getting to the point where the crowd believes in endless growth, the smart money, the institutional investors, start selling at the top. Volume is fading on the way up. As the price increases, the amount of trades decline. Much of the big money, the institutional investors, are getting out of the way. There are also a number of chart indicators that are bearish. And the point I'm making is, if you have one bearish indicator, that is a hint. When you have multiple indicators all at once, that's a warning you just cannot ignore. Really love this post I saw from a stockbroker. It feels like deja vu, and I have those same feelings. Again, it's my 27th year in this industry. He stated, I was sitting in my terminal watching these prices in action, and it's mind-blowing. It reminds me of those days during the dot-com era. I'm sitting here saying, holy cow, look at these stocks soar. And I don't want to sound like a broken record, but the correction is going to be vicious. I don't want stocks just to keep going up because that's not healthy. And I don't think the COVID class of new investors that came on the scene largely after the 2020 hysteria have ever experienced anything like this. And I'm just sitting here shaking my head. And then he pointed out, before the comments call me a doomer and a bear, I'm not. Long term, I'm extremely bullish, but a sustained hysterical rally like this is going to lead to absolute chaos. I thought that was a really, really powerful post for somebody that's been there, done that. Something known as one of the most dangerous sell signals in stock market history. It's called a climax run. And it comes from William O'Neill. He was the founder of Investors Business Daily. He'd studied over 100 years of stock charts. And his findings found that after months or even years of a sustained uptrend, which is we certainly have experienced, the price suddenly accelerates. We've seen that happen in just a matter of weeks or months. The chart even starts to go vertical. Volume explodes. Headlines turn euphoric. As he stated, that's not a sign of strength. That's exhaustion. And as he put it, the intuition was, the climax run is the moment when the last buyers rush in out of fear of missing out. And fear is a powerful motivator. The smart money bought a long time ago. And now they're selling to the late buyers. And then when there's no one left who hasn't bought yet, there's just no more buyers left. William O'Neill put it, the market doesn't fall because the story is wrong. It falls because everyone who believes in the story is already invested. And he used famous examples of Cisco in 1999, climax run, and then dropped 89%. Qualcomm, 88% drop. Tesla, 2021, climax run, lost 73%. SMCI 2024, climax run and then dropped 85%. O'Neill's advice was act like a robot. Take the gains and walk away calmly. It's one of the hardest things to do because the emotions, the fear of missing out, the euphoria. But you just have to be willing to leave the party while the music is still loud. I've seen this myself personally with hundreds of investors over my career, where the euphoria, the excitement, they don't want to leave because the music's still playing. And although logically they understand the risk, diversification, how important those types of things are, the ideas of maybe take some of your winnings off the table when you're doing really well. You see the same type of mentality, emotions in Vegas. Those casinos weren't built from people that won money. They were built from the people that played too long because they didn't get out before the music stopped. And look, I don't know when the music's going to stop, but all the signs are becoming extraordinarily strong. And the echoes of 2000 and the dot-com, whether it's the accounting tricks that the tech companies are using, the AI companies, the weaknesses in the economy with the consumer, whatever it may be, I don't know what the trigger is going to be. The fact that adoption of AI largely goes to the much, much cheaper Chinese models. So the valuation of these companies is extraordinarily overextended. I don't know the cause. No one does. But something is going to trigger this euphoric extension of the market that we're seeing that's echoing the dot-com era. You don't believe me? Look at a chart. The similarities are eerie. It's eerily similar. And what I don't want to see happen is what I saw happen to many, many people after 2000. Saw the same thing in the financial crisis of 08, 09, when their portfolios had dropped 20, 30, 40, 50% or more even. You know, the NASDAQ in 2000, top to bottom, dropped over 70%. And I know, though, people say, oh, that can't happen again. We heard that back then. We've heard that every time. But as these things start to drop, then they get stuck in a different cycle. Well, now I've got to hang on and make up the losses. The 08-09 correction, the Great Recession, if you were in the S&P 500, it took about 5 to 6 years just to get back to even, which meant you made no money during that period of time. You're just retracing old ground. If you were in the S&P 500 in 2000, it was famously called the lost decade. Many of you remember that. And why was it called that? The majority of people who were invested in 2000 didn't get back to even or back to where they were until about a decade later. If you were invested in the NASDAQ, that took 15 years to get back to where it was because the drop was so significant. Again, over 70%. And those recoveries of 5, 10, even 15 years. Did you make any money during that period of time? If you were invested previously, the answer is no. You were just retracing old ground. And this is why an index product is so powerful. We have unlimited upside, no caps, no fee products. When people hear that, they're shocked and amazed. Many folks, even bankers I've spoke to, advisors, agents, highly sophisticated, educated investors who bought into these products, thought they had a good product and had limitations. They didn't realize index annuities didn't exist without caps. They do. There's many that do. And many exist without fees and unlimited upside and with 100, 200% participation rates, which means if the index goes up 10%, you get 100, 200% or 10, 20% of the returns with no downside risk. They guarantee the downside. When you lock in a gain, that becomes a new principle. There's even options available where you can lock in the gains anytime you want, any day of the year. These are not the index products of yesteryear. You may have looked at just even a few years ago, or you may even have. Euphoria that we're dealing with now in the markets. And if you do still believe it's going to continue to go up from here, great. These index products will continue to rise strongly. I've had many of my clients get over 20% returns just in the past year or so. But if it does correct, if history does repeat itself, like we saw in 2000, like we saw in 08, 09, You don't have to participate in that. And then you don't have to suffer the loss of time, 5, 10, even 15 years to get back to where you were. Because after a crash, what happens? There is a recovery. With the index product, you can participate in that recovery without the loss, which means you're most likely going to have a whole lot more money in your account. Contact me at yourpersonalbank.com for more information. Stay tuned. I'm going to share some information about interest rates, long-term bond yields, and why these index products are performing 2 and 3-fold, 300% better than they were even a couple, 3 years ago. I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. Something has happened prior to nearly every major market collapse in modern history. Investors were convinced danger had passed. The media oftentimes would call it a new era. The markets could never go down. The rally felt unstoppable. And one of the common denominators on many of these market crashes were consumer price index crossed above 3.8%. In other words, inflation. Well, guess where CPI is approaching now? It's getting close to that 3.8% mark again. And this time, the S&P 500 is sitting at all-time highs. If inflation continues to rise, long-term bond yields will likely soar, and that will almost certainly the stock market down and down rapidly. You see, one of the ideas that stocks protect against inflation is really one of the most dangerous myths in investing. It's almost up there with the one I share all the time about if you want guarantees, you have to give up strong returns. That's totally false. Index products have tremendous returns. Again, I have products that have averaged 10 to 14% average annual returns for the last 10, 15, 20 years, documented history, net in your account. Those are the facts. If you have had or have an index annuity product or IUL that has had poor performance, let's say less than 7% annually certainly over the last few years, it's not the product's fault. It's not the industry's fault. You're in a bad index, most likely. Or you're in one that's limiting you, like you've got a low cap or something like that, where you can only maximizes your returns. Why settle for a 3 or 4 or 5% annual cap product, for example, when you could have an unlimited cap product? That makes no sense. Or how about fees? You're getting eaten up with fees, so your growth is curtailed. Well, there's no fee products available. I'll show you dozens of them. Participation rates also. I've seen participation rates as low as 20, 25%. I've got products with over 200% participation rate. What does that mean? If your index goes up 10% and you have a 100% participation rate, you get 10%. If you got a 200% participation rate, you get 20% return. Credited in your account. I'm talking actual numbers credited in your account because that's what matters, right? So if you're not seeing those kind of returns and you have an index product, contact me at yourpersonalbank.com. Why suffer through a poor performing product when so much better options exist? And let me share with you why a newer product will significantly outperform an existing one. It has to do with long-term bond yields. When you invest in an index annuity, for example, what does the insurance company do with that money? For the most part, they buy bonds. They invest in a few other things, alternative investments, IPOs, various things to juice returns. But the majority, upwards 70, 80% of their portfolios are in bonds. They don't risk the bond. This is why they can guarantee the principal. They put the bond in their safe. And what does that bond do? Well, it throws off interest. And so the insurance company takes the interest from the bond and invests in options. If you're in a 1-year S&P 500 index, for example, they'll buy 1-year S&P 500 index options. And if you understand anything about options, is if the underlying asset, the index goes up, an option can go up exponentially. A 10% increase in an index could see a 100% increase in an option. So with the small amount of money used to buy the options and an increasing underlying asset value, they calculate it out. So if the asset went up, so let's say the index went up 10%, you would get credited that 10% or even more. Again, I have 1-year index options with no fees, no caps, upwards as high as 200% participation rates because they're investing in the options, and the options can have exponential growth. The other side of the coin is if the underlying asset, the index, goes down, the option then expires worthless. But does the insurance company owe you anything? The answer is no. They still hold the bond. Remember, they kept it in their safe. They didn't risk it. What does the bond do the next year? Throw off more interest. They buy more options, repeat the process. And how the insurance company makes money, by the way, people ask me all this all the time. How can they do, say, no fee, no cap, 100% or more participation rates? It's quite simple. Those options that increase exponentially are returning even more than they're paying you, so they're keeping the overage. So if your index went up 10% and you had a, let's say, 140% participation rate, let's just use that as an example. I have real examples of this. Your credit is 14% in your account, net, net, net. No cap, no fee. That's how it works. Obviously, the option went up more than the 140%, so they're keeping the overage. So in the good years, the insurance company's making money. That's how they pay me. I get paid commissions from the company. I don't charge fees to clients. Many financial people do. I don't. So that's how they make money, their profit. Everyone wins. I get paid. You make money. It's a win-win-win. Another way insurance companies can make money is through easy, obvious as fees. If you have fees in your index product, would you rather have lower fees or no fees? That's rather obvious. There can be a trade-off sometimes if the participation rate and upside potential, no cap, is high enough. I've got companies that'll bump from 140 to 180%, for example, if you're willing to let them charge you a 1% annual fee. And sometimes that can make sense. So if your index goes up 10%, you have a 180% participation rate in 1 year, let's say. You get credited 18% minus the 1% fee, so your net would be 17%. Some people prefer that, and obviously the 1% fee is how the company makes money, pays me, etc. So it's a trade-off. Which do you prefer? Caps in general, I'm not in favor of, and this is the one where people get caught up in the most when they got poor performing indexes. They're stuck with these low caps. I spoke to a gentleman yesterday who had done a significant amount of research, had talked to multiple financial folks about index products, had determined that he liked the idea of the downside guarantee, felt like it was a good fit, felt like he had a great product, felt like he had spoken to some very experienced agents, advisors, etc., but had been led to believe that all of the index products available had caps. And the reality is that is totally and completely false and pretty much always has been. What unbeknownst to him is likely he was talking to an agent or advisor, had limited availability of products. And although their products available all had caps, probably, that's not true. About 10% of agents and advisors, I'm told, in the industry are independent, like myself, and have access to basically every product. Look, a simple question you can ask is, if you're looking at an index product and an advisor can't show you literally hundreds of products and dozens of companies, that tells you right off the bat they're probably limited in their product offering. or may not have the best product available. But in general, I'm negative towards caps because, as they sound, they cap your upside potential growth. Unless the cap is really high, if you have a cap less than 10 or 12% annually, I wouldn't even consider it. I talk to people all the time who have 3 and 4 and 5% annual caps. Why limit yourself to a product with a 4% cap when you could easily get one that's 10 or 12, 2.5, 3 times the potential upside gain per year? And I'm not saying those are the best options. Those are the best products. There's better ones, I believe. But you can see that very clearly. Now, why are the newer products so much better? It's really quite simple. When you purchase, as I stated earlier, an index product, the insurance company buys a bond primarily. Don't risk the bond. They put it in their safe. The interest off the bond to buy the options to get these returns. If you bought an index product, say 3 years ago or longer, what were interest rates? What were long-term bond yields paying? About 3 years ago, a 30-year treasury was paying about 2%. If the insurance company is getting about 2% interest off that bond, how many options can they buy from that? It's pretty limited. Today, what's the 30-year treasury paying interest-wise? 4.5%, 5%. That's 2.5, even almost 3 times more interest bonds are paying interest than they were 3 years ago, which means the company can buy 2 to 3 times more options, which means your returns can be doubled or even tripled. If they buy a 30-year bond, that means that interest rate is going to happen guaranteed every year for the next 30 years. So whatever the rate was when you purchased that index annuity product 3, 5, 10 years ago or so, you're stuck with that low rate, that low interest, and the limited upside growth potential. If you transfer it, roll it over, you can do it on a tax-free basis through a 1035 exchange or rollover typically. If you have a penalty, there's bonuses that'll more than offset any penalty you may have. And you can then allow the new company to purchase the new bond that's going to pay double to even triple the interest rates that your old one was getting, which means your returns will be double to triple in the future. And the interest they're getting paid on these bonds is guaranteed for typically 20 and even 30 years. This is not guesswork, folks. This is locked in. If you want more information and you want to learn how to double, even triple the returns on your existing annuity, index annuity product, or you're looking at starting one, contact me, yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.